Hey, Jason here. Today's video, I'm going to answer the question, should you invest in Perdoceo? Hopefully I'm pronouncing that right. Education Corp, stock ticker PRDO. This is an investment analysis for Ocean, who requested this on YouTube. Thanks so much for requesting this. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms. Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and we release new videos all the time. Okay, if you see my other videos, I apologize for this. I don't want to do this, but I have to do this because every time I don't, I get nasty comments. I do not short sell ever. So I don't short sell any stock I talk negatively about, and I don't own any stock in a company that I talk about positively in a long position. These videos are done at the request of viewers every month for the last 3, 4, or 5 months, and every video going forward for at least the next month. It's requested by a viewer to help them and to help you watching this learn how to better evaluate stocks faster, better, more efficiently. So you can discard crap companies faster, spend more time investing in or researching and evaluating good-looking potential stocks. Because these are reviewer requested, most of the time I don't know what these companies do. I purposely keep it that way. Why? Why do I purposely keep it that way? Because I don't want what they do to bias me either negatively or positively as I go through these numbers. I want it to be fresh and kind of a live look into what I'm seeing. Because of that, at this stage of my analysis, I don't care about what the company's future is. I don't care about what the CEO says they're going to do. I don't care what their plans are. At this stage of my analysis, which is the second stage of my analysis, a company has to have minimum margins, balance sheet strength, margin of safety requirements. That's what I'm looking for. What is that? Or that's what I'm looking for at this stage. So because of that, I don't know what the company does, and frankly, I don't care at this stage. Why should you listen to anything I have to say? In the first 9 years of my career, I've produced average annual investment returns of 23.5% per year on average in the portfolios I manage. This puts me just behind the great Warren Buffett in the first 9 years of his career, or when compared to the first 9 years of his career at the Buffett Limited Partnership, where he produced average annual investment returns of 24.2% return on average. These numbers legitimately make me one of the best stock pickers in the entire world over the last 9 years. And I'm not saying any of this to brag. I'm just saying it to prove to you that I actually know what I'm talking about a little bit. Okay. So, again, this is investment analysis, Perdoceo. Hopefully, again, I'm pronouncing that right. Education Corp. PRDO is the ticker. This is from Ocean, who requested this on YouTube. Okay, sub $1 billion company. Love these kind of companies. Again, anytime I talk about these companies, I have to warn you out there. Companies typically under $1 billion, you need to be careful with, and you need to be extra careful that you watch for red flags, because a lot of these companies, because of their smaller size, they aren't necessarily as stable as bigger companies, and that generally can make them more risky. So please keep that in mind anytime you're evaluating smaller stocks. Even though they're my favorite, many of them are not great. Okay, I don't care about forward PE at all, but this being 7.53 is one sign the company might be undervalued. Okay, Perdoceo Education Corp is an American for-profit education company that focuses on campus and online post-secondary programs. The company's important segment is its online universities, which include the American Intercontinental University and Colorado Technical University. These online universities provide undergraduate, graduate, and doctoral degree programs focusing on business, technology management, and social services. Career Education Corp is focusing on its online universities as it continues to reduce its on-campus program offerings. The majority of the company's revenue comes from the Colorado Technical University segment. Okay, keywords here. American for-profit education company. In the last probably 5 to 10 years, these companies have gotten extreme high scrutiny. Frankly, for a good reason. Many of them were shown to be, to a degree, frauds. They were doing things that they shouldn't have been doing, and students were learning what they should have been learning and stuff like that. So I'm not saying this company is doing that. I've never evaluated this company before, but that is something to watch out in this sector, is what I am saying. Okay. Their revenue has cratered from 2011. They had revenue of just under 1.9 billion rounded up. Now the revenue is 700 million in the trailing 12 months. That's a huge drop. Let's see what that's done in part to their stock. Okay, 10 years. Their stock is down 50% in the last 10 years. Most of that fall is from their high in 2011. So if you go back like 9 years, let's see, let's move this a little bit. Yeah, if you go back a little bit forward at that point in time, then their stock is actually up by about 50%, even though their revenue's down. So that's another reason you got to be careful with these kind of things, because if you look at any one point in time, there's another example that's about, 12, 13 years back. They're down 40%. If you look further forward, they're up huge. So you need to be careful with those kind of charts, which is one reason I'm not a huge fan of charts, because it just picks out one point in time, and yet it's usually in the analyst's favor. Their operating income has not cratered. Their operating income went from 231 million in 2011, went negative for most of the next 4 years. Slight profitability in 2016, then bigger profitability in 2017, and then their huge profits in the trailing 12-month period at 27.8%. I look for anything above 10% on a consistent basis here. So for the last 4 plus years, they've surpassed that. For the time period before that, they did not. So what does that mean? Frankly, we need to do the rest of the analysis to figure that out. Share count has gone down a little bit, which means they've bought back some shares, since 2011. Their share count's gone down from 74 million in 2011 to 71 million in the trailing 12-month period. Typically, buybacks are a great thing for companies if the company is undervalued. The book value per share has also gone down pretty substantially, from $12.86 per share in 2011 to $8.35 per share in the trailing 12-month period. It cratered drastically in 2015. That was one of their unprofitable years. So my guess here is that there would be some impairments probably along the way that would that they had to impair some assets, and that that's why their book value per share decreased, because that decreases the value of the company's assets, especially compared to their liabilities. Book value per share is the amount of assets, total assets minus total liabilities, the money left over, and then you divide that by the number of shares to get book value per share. When the assets column goes down due to impairments, and we'll see that in a little bit, if that's for sure, that decreases the book value per share as well. ROIC is fantastic now. Low and negative, massively negative, in the early part of the decade. In the last 3 plus years, it's 14 to 22%. Right now it's 21.57%. That is fantastic. I would look for anything above 10% on a consistent basis there as well. Free cash flow to sales, again, also fantastic now, not so great earlier in the decade. 24.3% now, negative for most of the decade. Right now, though, they look like a great company in terms of their profitability margins. ROIC and operating profit or operating margin, I look for anything above 10% on a consistent basis. So they surpassed that recently, not consistently over the last decade. I look for that consistency. The free cash flow to sales is, I look for anything about 5%. There's 24.3%. Again, that's fantastic, but it's not been consistent. So I would want to know, looking back in the annual reports, what happened before 2018. That's what I would want to know. That's what these numbers are showing me. Before 2018, this company was having massive problems, massive unprofitability, maybe a massive transition, loss in a ton of business, and then 2018 they turned the corner. What they turned the corner from, I have no idea. They have a huge amount of cash on the balance sheet. Cash, short-term investments make up almost 60% of the balance sheet. They have no long-term debt. That's great. No short-term debt. That is great. They do have some other long-term liabilities. I would want to know what those are. But from that view, it's very clean. They do have a cash conversion cycle. I'm not sure why, because they are an online education company. So frankly, we're going to skip this because I don't know why this would matter for them. I should probably go back and give some context to that. In case you haven't seen my other videos where I talked about cash conversion cycle is important for companies with hard assets like manufacturers, retailers, clothing companies, stuff like that. For online companies, not so much unless you're like an online retailer type of thing. And it's definitely not for like an online education company. That's not a hard asset, so I don't even know what they would be measuring here. Okay, usually when we talk about interest coverage ratio, it's because it's negative, and that's a bad thing. This is massively positive at 635.5 rounded up. Interest coverage measures the amount of if the company can cover its current interest payments on its debt with current levels of operating profits. It can because it's ultra profitable and it doesn't have a ton of debt. It probably has some on the balance sheet, even though it doesn't show up on the other sheet we just looked at. It probably still have some. So that's why this number is so huge, because they have a huge amount of cash. Anything over 1 is considered great. Anything below that is considered not good. Okay, so they do have a little bit of debt. Let's go and see what that is because it didn't show up on the other sheet. Okay, it's empty to the bottom of the screen. Not sure why. Okay, so they have a ton of cash and short-term investments. They have $447 million in cash and short-term investments. Their entire market cap is $836 million. So what this means is that gives them a huge margin of safety, because they have half their market cap in cash. We will see if that's realistic, or adds it realistically in a real world sense, adds a huge margin of safety, or if there's other kind of mitigating circumstances going forward. A decent amount of property, plant, and equipment. Again, not sure what that is unless that's like servers and stuff. It's $130 million though. Not sure what that would be. Goodwill. So they do have a ton of goodwill. Let's go back and see if that has been impaired at some point. These are USD dollar billions on the annual, but they're quarterly on their millions. So that's something we've got to watch. So in the last 5 years, they have not lowered their goodwill, which is one thing I was thinking maybe they could have impaired. Oops. And they have a very clean balance sheet. Do have some debt. Total current portion of long-term debt and capital leases, about $10 million. $40.4 million in total long-term debt and capital lease obligations. So they have a ton of cash compared to very little debt. That does give them a huge margin of safety. Yeah, their balance sheet is very clean. Not unsurprisingly, because of their business model. Still a bit confusing on the book value per share, why that would drop so much, but you might see it on the cash flow statement because they talk about impairments on the cash flow statement. Let's first look at the quarterly numbers, then we'll go back and look at the annual. Purchase of investments. Purchasing a ton of investments here. 123, 69, and 126 million in the last 3 quarters. What would that be? Maybe they run their own portfolio, investment portfolio. I'm not really sure what an online for-profit university would be investing in like that, unless it's other online universities. But it said most of their profits and revenues come from one segment. So that's a little bit confusing. Okay, let's go to the annual. Didn't see much on the cash flow statement. Impairments. So they impair a lot every single year. Impairment write-off of other assets, non-cash adjustments. They have between 27 and $50 million a year, every year, since 2016 in impairments. That's weird. Most companies, when they have impairments, they do one big one, like when they have a loss on something. Like you're seeing companies impair their Bitcoin. I think Tesla and some other companies impaired their Bitcoin that they bought in the first quarter of 2021 because it's gone down a lot in value. So they've impaired some of the value on that. Not sure what they would be impairing every single year, but that's why their book value per share has gone down so drastically, is these numbers right here. And I can't highlight them, but it's this right where my cursor is. Again, that's weird, especially for an online education company. I would want to know specifically what that is. That's not a good thing for them to have. Impairments kind of in general are not good. But it's weird that they have them every single year, that in very similar amounts. That's weird. Again, the purchase of investments as well. Purchase and sale of investments. They do that every year as well, to large amounts. They purchase more investments every year than they sell, except for in 2019. I would want to know what that is as well, because that's a drag on the company in the last year of $120 million. We'll want to know what that is. So those questions have got me curious. Impairment. Again, the process you're seeing here is the same exact process I go through every time I look at a stock. Okay. Impairment. Asset impairment. $612 million in the entire year 2020. That relates right here to the right of use asset for a vacated facility for a closed campus for which the sublease income was deemed no longer recoverable. What does that mean? That means they had another campus facility where they weren't generating enough income to make the asset, or to make the potential investment worth it. So they impaired the full amount. Let's see if it talks further about specifically what that is. Same thing. So impairment. It does not. It just says the same thing over and over again. So my guess is this is another campus they bought, another campus they bought at some point, and they either shut it down or it wasn't working or whatever, and they lost their, essentially what this means is when they impair the value of this, in this case $612 million in 2020 alone, that means the value of that leaves the balance sheet and it lowers the balance sheet strength. Now, as we saw, their balance sheet is still very strong, but this essentially, with the stroke of a pen, the way I like to describe impairments and write-offs, with the stroke of a pen, these write off or impair whatever the amount is. And when I say that, that means it destroys the value. The balance sheet, before they signed this agreement to impair this amount, was $612 million stronger than the second after they signed this agreement to impair this amount. And again, I don't know specifically what this is because it doesn't say. This is interesting. A legal settlement for the FTC. That's probably related to for-profit stuff I was talking about earlier. So that's a concern. Want to know what's going on there. But At this point, the company looks like a decent investment, barring these kind of concerns here. So let's go see what its valuation is. Okay, it is enormously undervalued. This is where most companies go to dive for me. So this has I don't care much for PE, price to cash flow, or forward PE, but when I do, I want to see these metrics underneath 20. Perdoceo has a PE of 6.83, price to cash flow of 4.77, forward PE of 7.53. So those are all well under 20. The enterprise value to EBIT, the most important number on here, is 3.03. I look for anything below 8 to consider the company undervalued. So this shows the company is massively undervalued. How massively undervalued? I've only seen, off the top of my head, 3 companies that had lower EV to EBIT ratios than this. So this company is enormously undervalued based on the relative numbers. However, what I would say about this company, and maybe we can do another case study on this, but for now, this company is very interesting to me because mainly for its enormous undervaluation. So when I have something that kind of has some concerns like this, but it's massively undervalued, I do more research, which is what you're seeing now. I'm trying to figure out what those investments were on the cash flow statement. Purchase of available for sale investments, sales of forfeit. So there was the notes. We acquired a company in 2020 here. Student university technology, but it doesn't say specifically what these are. So that's interesting as well. So we may come back to this company at some point, Ocean. This is a great case study. Most have been pretty straightforward at this point. Either, yes, this looks like a good company. No, this does not look like a good company. This one is intriguing because it is different. It is in the middle. Has some concerns that are brought up and what I would want to know more about, but it's massively undervalued. It has huge margins in the last couple of years. I would want to figure out if those are sustainable. So we might do another case study on this, frankly, because it's a good case study candidate. So I do another investment analysis of this, but so far, those are the things that I see for Perdoceo. Again, correct me if I'm wrong in this. It's probably driving people insane if I'm saying it wrong. So please correct me if I'm wrong. Great margins in the last couple of years. Unprofitability for most of the last decade before that. So some kind of huge transition went on. FTC stuff with for-profit universities, impairments, massive impairments, investments, and continual purchases of investments. I would want to know what all these things are, but because it's such an intriguing company, we will probably look at it again sometime. So Ocean, great analysis here. Again, undervaluation as well. I can't forget about that. That's massively undervalued on a relative basis. So we will do another video on this at some point and do the full second stage analysis, or full second stage of my analysis. We'll actually do the worksheet on this company and to see what's going on, to see if we can figure something else out about the company until we take it to the next step, which is, for me, actual reading the financial statements or the financial reports like the 10Ks. Okay. Very good case study though. Hopefully you found this interesting. If I missed something, if I didn't explain something well enough, if I should explain something better, let me know in the comments below. If you want me to evaluate a stock like this for you, let me know in the comments below. Every stock I've done for the last 3, 4, 5 months, and every stock for at least the next month or 2 is for people who are requesting on YouTube. If you want me to look at a company for you, I am now, because we've relaunched our masterclass, which I'll tell you about in a second, I'm giving preference to people in our masterclass. But barring that, if you're not a member of our masterclass and you want to review a stock, let me know and I'll put it in the calendar. If there's 3 criteria. It's not a bank. I don't evaluate banks. It's not an insurance company because you actually have to dig into the 10Ks to evaluate those. And if it has to be producing revenue. Why does it have to be producing revenue? Because what I said at the beginning of this video of not caring about what the company says it's going to do, what it plans to do, all that. I evaluated some stocks for people who wanted me to evaluate stocks that were doing revenue, and the analysis was pretty boring because I don't care about that stuff right now. So if it fits those 3 criteria, let me know a stock anywhere in the world you want me to look at, and I'll add it to my calendar. If you're wanting more specific, or if you're listening on YouTube, sorry, thanks so much for watching. Really appreciate it. Make sure to like, love, share, subscribe, comment, all that good stuff. Also, make sure if you do subscribe to hit the notification bell so you're notified every time we release a new video, and I'm releasing new videos all the time. If you're listening on the podcast, again, thanks so much. Do all that same stuff except for on the podcast. We'd also really appreciate a review because the more reviews, views, and listens we get on our content, the more people we can help. Excuse me. If you want more specific help from me on how to become a better investor faster, check out our free resources below. You can get our 5 free gifts, including the worksheet that we're going to do next time on Perdoceo. And we've already done this on a couple stocks. I think WidePoint is one. So if you want to see that worksheet in action, you can check out, I think it's video number 2 on WidePoint. And you can get that as part of the 5 free gifts below. That's one of the free gifts. You can also get a free PDF copy of my book, How to Value Invest, and a free and our free guide, 7 tips to picking great stocks and 3 times you must sell. If you're looking for more specific help from me, make sure to check out the link below for our newly released masterclass, which I'm super excited about. We've already getting students in, and we're going to start our live trainings soon in that group as well. As soon as we get enough people signed up, we're going to start doing the live trainings for those as well. And you can get information on that below. But until next time, have a great day. Talk soon. Bye.